Welcome to today's Explainer. We are diving straight into what is essentially a mathematical survival guide for insurers dealing with massive disasters and wildly spiking costs. We're going to unpack a deeply researched paper titled Dynamic Physical Hedging Amid Jump Losses, Reconstruction Price Uncertainty, and Population Interactions. Now, that's a mouthful, but it tackles a really complex, high-stakes question in catastrophe insurance. And don't worry, we're going to break down all this rigorous math into a totally clear, step-by-step journey.
Picture this for a second. A massive hurricane makes landfall. Homes are totally destroyed, businesses are wiped out, and obviously, the insurance claims just start flooding in. But here is the critical problem. The cost to rebuild? It doesn't stay static, because suddenly everyone needs lumber, they need concrete, they need contractors, all at the exact same time. So prices absolutely skyrocket. It's what the industry calls a demand surge. Think about it. What do you do when you have to rebuild an entire community, but your raw materials and labor suddenly cost twice as much as they did yesterday? That overlapping threat is exactly the nightmare scenario this research models and solves.
So here's our roadmap for today's Explainer. 1. The catastrophe double whammy. 2. What is physical hedging? 3. Modeling the unpredictable. 4. The mean field game. 5. Industry domino effects. And 6. Takeaways for risk managers.
Let's jump right into part 1, the catastrophe double whammy, the overlapping risks of jump losses and inflation. The researchers start by making a really important distinction. The catastrophe itself and the replacement cost are actually two completely distinct mathematical variables. On one side, you have your discontinuous catastrophe losses. These are the sudden, massive shocks governed by what mathematicians call a marked Poisson random measure. Basically, that just means both the timing and the size of the disaster are totally unpredictable. Then on the other side, you've got continuously fluctuating prices. That's your baseline cost of construction, which drifts around based on normal macroeconomic factors. The real danger here, it's when you multiply them. When a disaster hits, the monetary loss that drains an insurer's surplus gets scaled up by that wildly elevated reconstruction cost index. It's this compounding multiplier effect that is just devastating.
Now check out this number, 35.8 days. This is the empirical mean reversion half-life of a construction cost shock. The researchers calibrated this data to show that post-disaster price spikes are incredibly sharp, but they're also fleeting. So if an insurer can somehow survive or just bypass that unbelievably expensive 35.8-day window right after the storm, reconstruction costs actually start normalizing back to their long-run averages. The whole challenge is just surviving that peak.
Moving on to part 2, what is physical hedging? Preparing before the storm hits.
This brings us to the core concept of the paper, physical hedging. By definition, this means securing physical rebuilding capacity. We're talking prearranged contractor time, locked-in building materials, long before disaster ever occurs. Crucially, the authors make it clear that this isn't just about shuffling money around or hoping reinsurance bails you out after the fact. No, it's about physically altering the severity of a loss before it even hits your balance sheet. By having contractors practically on speed dial, an insurer physically reduces their residual loss fraction purely because they aren't forced to pay those hyperinflated post-disaster market rates.
But of course there's a catch. Insurers are trying to balance a really tricky three-way equation to minimize their total social cost. First, you have the resource cost of hedging. It costs real money today to keep contractors on retainer. Second is the social burden of elevated reconstruction costs. That's the financial pain of paying those insane demand surge prices later if you didn't hedge enough. And third is the capitalization weakness penalty, basically the risk of total ruin if the company's surplus drops below a critical baseline. All the math in this paper is dedicated to finding the absolute lowest total sum of these three competing pressures.
Let's get into part 3, modeling the unpredictable, the probabilistic foundations of catastrophe insurance.
We really need to dive deep here because this is where all the high-level theory meets the real world. The researchers build out a set of rigorously calibrated empirical parameters to run their models. Let's walk through them. First is the alpha parameter, set at a baseline value of 1.71. That's the catastrophe loss tail exponent. It's vital because an exponent of 1.71 guarantees the model reflects truly extreme heavy-tail disaster scenarios, not just your run-of-the-mill thunderstorms. Then we have the kappa parameter at 7.07. That is the mean reversion speed of those construction costs, which is exactly the math driving that 35.8-day half-life we talked about earlier. Next is sigma I, sitting at 0.20, representing the benchmark volatility of construction costs. And finally, T is our 5-year numerical time horizon. Literally every calculation in this study relies on these specific empirical baseline values to perfectly simulate reality.
And when you apply those calibrated cost weights to the models, something really striking jumps out. If you look at the breakdown, the baseline net premium inflow is actually pretty small, sitting at 0.08. The quadratic physical hedging cost comes in at 0.20. But the demand surge cost weight is massive, set way up at 0.50. It heavily outweighs the other two. What that does is force the mathematical model to take post-disaster inflation incredibly seriously. The numbers prove without a doubt that an elevated replacement cost state fundamentally magnifies every single aspect of disaster damage.
So how do they solve this? The researchers deploy something called the non-local Hamilton-Jacobi-Bellman equation, or HJB for short. Sounds intimidating, right? But let's de-jargonize it a bit. All this equation really does is find the perfect sweet spot. It continuously calculates the exact mathematical point where the marginal cost of buying reconstruction capacity today perfectly matches the marginal reduction in catastrophe exposure tomorrow. It's the ultimate balancing act, just translated into calculus.
Which brings us to part 4, the mean field game, zooming out to the industry level.
Now this is where things get really fascinating. When hundreds of insurers are all making these decisions at once, it creates a massive feedback loop. The paper models this as a mean field game. Here are the steps. Step 1, an individual insurer decides to change their physical hedge. Step 2, because they and everyone else are doing this, the total industry's aggregate vulnerability actually shifts. Step 3, that macro-level shift changes the strategic cost to rebuild for everyone across the board. And Step 4, that original individual insurer suddenly has to adapt their strategy all over again to fit the new reality. It's this endless loop where everyone's survival strategy literally impacts everyone else's vulnerability.
To figure out the math behind this mean field game, the researchers had to build a seriously complex numerical solution sequence. They used what's called a coupled backward-forward system. At year 0, they set the initial capitalization state. Then, they go backward using that HJB equation to find the optimal hedging policy, and forward using a Kolmogorov equation to simulate how the entire insurer population evolves. Step 1 uses exact time stepping for the cost factors. Step 2 runs heavy-tailed Monte Carlo simulations to model the unpredictable jump losses. Step 3 uses policy iteration to handle the hedging feedback. And finally, Step 4 runs a mean field fixed point iteration. Basically, it churns through all of this until it finds the exact equilibrium where no single insurer wants to change their strategy.
Part 5. Industry domino effects. Direct mitigation versus distributional shifts.
The research neatly separates the outcomes of all this hedging into 2 distinct effects. First, you have direct attenuation. This is the immediate, direct relief you get from securing your own contractors. You are directly shrinking your own monetary exposure to catastrophe loss. It's you taking care of yourself. But the second is the distributional effect. This is the big macro effect. When the entire insurance industry changes its hedging behavior, it shifts the aggregate population laws. That alters strategic externalities, which is just a fancy way of saying the overall cost and risk environment for the entire market is fundamentally transformed by collective action. To really prove this out, the researchers built out a 3x3 benchmark grid. They mapped an insurer's surplus state, meaning how much capital they have on hand, ranging from weak capital at 0.40 to baseline at 1.0 to strong capital at 1.60. Then they crossed that against the severity of a demand surge, low, baseline, and high. By running their complex jump diffusion equations through all 9 of these test scenarios, they definitively proved that a company's optimal response depends completely on their cash on hand. If you're a weakly capitalized insurer stuck in a high-demand surge environment, you are mathematically forced to rely way more heavily on physical hedging. Otherwise, you face total ruin. Finally, Part 6, Takeaways for Risk Managers. Let's apply all this math to the real world.
So, what are the absolute core takeaways here? Number 1, elevated replacement costs don't just bump up average losses, they fundamentally magnify every finite moment of disaster damage. Number 2, physical hedging is brilliant because it reduces your residual loss fraction before that loss can ever touch your surplus cash. Number 3, locking down this physical capacity is most mathematically critical when reconstruction costs are already sky high and your firm is weakly capitalized. And number 4, industry-wide behavior matters. The mean field coupling we discussed proves that how your competitors hedge actively changes the equilibrium cost of your own vulnerability.
The authors actually hit the nail on the head right here in their conclusion. They wrote, numerical experiments show that reconstruction costs and capitalization materially affect optimal hedging and that cross-sectional vulnerability alters equilibrium costs. It's incredible how the rigorous mathematics entirely validates the micro to macro narrative we've been tracking. The overall state of the market and the literal cash sitting in your bank dictate exactly how much physical capacity you need to reserve.
So I want to leave you with one final thought to ponder. We've just seen exactly how overlapping threats and dynamic price spikes can completely devastate an industry if they don't have proactive, physical preparation. It makes you wonder, how vulnerable is your industry to a double whammy? What happens if the cost of survival spikes at the exact moment you need it most? Think about the overlapping risks in your own professional life and how you might start physically hedging against them today. Thanks so much for joining me on this explainer, and keep questioning the data.